Hello, everyone, and welcome to the first session of day 2 of the Modern Investor Summit. My name is Gabriel Nussbaum, otherwise sometimes known as That Money Guy, and I am very excited to be here with you to kick off yet another fantastic day of this summit. I am joined by two incredible guests to start us off here today. Firstly, Ted Malcolm, the head of UK ETF distribution at J.P Morgan Asset Management, and also Andy Prosser, the head of investments at InvestEngine. Today, you can look forward to an incredible lineup of insightful sessions featuring some of the top minds in investing. And some of the people that you will be hearing from today include Dan Ariely, the world's leading social scientist and best-selling author, Christina Hooper, the chief global market strategist at Invesco, Lawrence Calcano, the CEO at iCapital, and of course, our keynote speaker later today, Gregory Davis, the president and chief investment officer at Vanguard. So do let us know in the chat if you're going to be joining for any of those sessions today. I know that I'm going to be pretty much be at all of them because, those names, quite incredible, eh? So before we do get started, I do need to let you know about a few housekeeping notes. If you haven't already done so, please do introduce yourself in the chat, which you can see on your screen with your name and where you're calling in from today. And to let you know a little bit about this session, it is going to be a 20-minute discussion followed by a 10-minute Q&A. So do get your questions ready, start typing them in already, or throw them in throughout the session into the Q&A box that you can also see below. And on that note, I think it's about time that we dive in. So Ted, Andy, how are you both doing today?
Yeah, very well, thanks. It's nice to be here.
It's great to have you both. Honestly, I'm really looking forward to this session, probably a little bit selfishly to learn a lot more myself. And as hopefully most of you already know watching at home, today is all about mastering ETFs to capitalize on 2025's biggest themes. And I think that's a great place to start with. So, Andy, what are some of those key trends that are shaping the ETF market for investors in 2025?
Yeah, thanks for having me, first of all. Really excited to be here. I think there's a couple of key market trends that we at InvestEngine anyway are seeing. So the first big one, I think, is that there is a big growth in the rise of ETFs in general. You know, investors are really loving the vehicle. They're realizing that it's a really good, low-cost, diversified, transparent way to build portfolios. And we're seeing that come through in the success of the platform as well. InvestEngine is an ETF-only investing platform. We started the year with 300 million-ish on the platform, and we're now about 900 million. So it's a kind of big testament to how the ETF market is growing. And that's feeding through to growth in the business as well, which is great. Within that, we're seeing what we're seeing in our client base. We tend to see the kind of retail investors on the DIY side of the platform really do one of two things. Either they're kind of investing in a money market fund, makes total sense. Rates are really high at the moment, 4.75%. And a money market fund, for those who aren't familiar, it's a kind of cash-like product that offers better rates than a bank account. So they'll either be investing in that or they'll be investing in a full equity fund. So it's kind of bifurcated. It's one or the other. And that full equity fund tends to be like an S&P tracker or a global tracker, something like that. So there's this real split between clients taking no risk or taking kind of 100% market risk. And what we found is there's very few people kind of creating these true multi-asset portfolios on the DIY platform. And we'll get into it a bit later on, but that's kind of one of the reasons why we've tried to offer more options on the platform, including our life plan portfolios, which we've just launched last week, which are supposed to kind of give a nice halfway house between a DIY portfolio and a fully managed portfolio to help DIY investors build these multi-asset portfolios. But in terms of the biggest trends so far, just to summarize, it's really the growth of ETFs, the rise of people wanting the low-cost, transparent vehicles with the InvestEngine platform having great UI and great customer service, and then also that trend towards retail investors either investing in money market funds or investing in kind of global equity trackers. That's really what we're seeing at the moment.
Amazing. Ted, I'm actually going to throw that exact same question over to yourself as well. So from the J.P. Morgan side, what are some of the key trends within the ETF space that you're seeing?
Yeah, sure. No, thanks, Gabriel. And, I'll echo some of what Andrew said. The ETF vehicle per se is just in such a strong growth phase. ETF AUM globally has just crossed 14 trillion in assets. This is a market that only started 30 years ago in the States. So it's massive. This year alone, we've seen 1.3 trillion of net new money come into ETFs. And that's a 15 years of consecutive net inflows. So it's a really exciting part of the overall kind of investment landscape. Bringing it closer to home in the UK and Europe, we're still a relatively smallish market compared to the US, but we're capturing around 15% of the overall ETF AUM is sat with UK investors. Many, I'm sure, are dialed in today. But we are seeing faster growth here in the UK and Europe versus the US. I think, investors hopefully dialing in today are starting to really start to use ETFs a lot more in their portfolios. From our perspective at JP Morgan, though, what's going to be the next leg up? So our forecast is that we hit 30 trillion from that 14 number by 2030. And we think one of the key drivers that's going to really get us to that number, and something for all of you to keep an eye on, is the concept of actively managed ETFs. Now, most of the market for the last 30 years has associated ETFs with passive and indexing, and that still is the bulk of ETF flow. However, this story of active management now within the ETF vehicle is getting a lot of traction. And what we're now saying is ETF does not have to equal passive. It is purely a vehicle, a technology, whatever you want to call it, a wrapper. And we are now incorporating really high quality active investment strategies within the ETF vehicle and giving you investors, whether you're a retail investor or the largest institutional investor, access to high quality active, which was quite hard to access previously. And you can now access it via an ETF, keeping it costs low, easy to trade. So that's really exciting. Early days, but seeing really, really strong momentum in that space.
Ted, I do want to follow up on that idea, because I think you might have just piqued a lot of people's interest with the word active and ETF in the same sentence. A lot of people traditionally think of, like you mentioned, the word passive being more related to ETFs. Some people thinking that ETFs have to be passive in some way, shape or form. So following up on that note that you were just talking about, what are some of the key advantages of incorporating this active ETF into a portfolio compared to the more passive option?
Yeah, no, good question. I suppose, we definitely see a place for both. And we're not coming saying just by active ETFs. We think a diversified portfolio should have a blend of passive and active ETFs. And that makes a lot of sense. I think the advantage that active management generally, and now within the ETF vehicle, can bring is the very obvious one, is the investment objective is to deliver excess return above an index. So a passive ETF's job is to track an index. That's how they should be measured. How close do they get from an index return perspective? Our job as an active manager is to beat that benchmark, to deliver excess return. And so if we do that, that is obviously great for you guys, because obviously delivers excess return. So that's the main thing. Outside of that, also think of active management as almost like a risk management tool. We can be a bit more flexible than maybe passive. If there's a big news event, big geopolitical events happening, which unfortunately there's a lot of geopolitical noise at the moment, we can be a bit more nimble. We can move in and out depending on our market view. We won't always get it right, but we can be nimble. Whereas an index, a passive, is obviously constrained to that index construction. And I think the other thing as well to think about is as we start to go into different asset classes, and we can talk on this probably later on, such as fixed income, which is not the most glamorous asset class, but certainly an interesting one. We believe active management has a really important role to play there, because when it's relative to passive, on a passive fixed income ETF, you weight your ETF and the index by how much debt a company has or a government has. So you are rewarding companies with the most amount of debt with the biggest weight in your passive portfolio, which for us feels slightly uncomfortable. On an active perspective, we'd be looking at the company fundamentals. What's its leverage? Can it service its debt? Is it a great company? If it is, let's put it in the portfolio. Let's overweight it. So I think active comes in all sorts of flavors, and we can hopefully get through this in the conversation today, but it just generally is a nice diversifier away from maybe your passive allocations.
Ted, I can already tell you that the questions are flying in about active ETFs. I did say you were going to pique people's interests, and you have definitely done that. So we will definitely come back to the topic of active ETFs. Do not worry if you're listening. We're not going to leave it behind right now. But Andy, I do want to kind of pass over to you regarding another hot topic with ETFs, which is thematic ETFs. I think it was quite a buzzword over the past few years when it came to kind of the ETF industry in general. So if you are a retail investor looking at thematic ETFs, with also looking to give yourself broader market exposure. How can you balance the two out together?
Yeah, it's a really good question. So I guess I'm going to take it in two parts. I think the first part is how to kind of select those active ETFs. And the second part is how to balance that with your broader exposure, right? So the first bit on kind of picking your active ETFs, fund selection can get really complicated, it can get very technical. But I'll try and just give a quick rundown of one of the very basic kind of frameworks of how people select funds. And the first step is to really just get under the hood of the ETF that you're buying, understand it really well. And I think a useful starting point for that is to look at what's called the 6 Ps. These don't just apply to active ETFs, equally as relevant for thematic ETFs or really any other fund that you're looking at. And it's a way of just really, as I said, getting under the hood of the ETF. So starting with the process, how is the fund put together? Is it qualitative? Is it quantitative? How are the stocks selected? How are they weighted? How are they rebalanced? Is it a concentrated pure play fund, or is it kind of broader thematic exposure? Second one, people. Who's managing the ETF? Is it one person? Is it a big team? Do they have experience in the region or the market they're selecting stocks for? Have they worked together for a long time? Do they have a long track record? That kind of thing. Third P, philosophy. What's the philosophy of the ETF? Is it passive? Is it active, like Ted was talking about before, or is it a bit of both? How far is it likely going to deviate from the benchmark? And are you okay with that level of active risk? Who's the parent company? Fourth P, are they a reputable ETF issuer? Are they committed to the strategy? Have they put resources behind it? Price, how much does it cost? Fees, obviously a big drag on returns over the long term. So it's important to make sure you're not paying too much in fees, especially when you kind of compare those fees to how much active risk you're getting in the portfolio. And finally, the big one, performance. How's the fund performed in the past? Is that real performance? Is it simulated? Is it gross of fees, net of fees? And how risky is that fund? How big are the drawdowns versus your level of desired kind of risk tolerance? So I guess that's kind of step one, really get into the nitty gritty, understand how that fund is put together. And then the second bit is to figure out how much that fund, that ETF should take up in your portfolio, how much you should allocate to it is the kind of jargon. And generally, I'd say when it comes to thematics, I'd recommend taking what's called a core satellite approach. And by that, I mean kind of figure out what should be in the core of your portfolio, i.e. what should make up the majority, so like 80 to 90% of your portfolio, and then figure out which bits fit as kind of more satellite positions, which make up the remainder of the portfolio. And in terms of which ETFs will go in which bucket, it does kind of depend on what kind of thematic ETF you're buying and how diversified it is. Like if you're buying an ETF that's in a really niche area, and has really concentrated exposure. So if you're buying something like a cybersecurity ETF or like a hydrogen ETF, something like that, then it probably shouldn't form part of your core allocation. It's just too concentrated, too high risk, it's not diversified enough. You can still have those ETFs in your portfolio, absolutely, but they should form smaller parts and should sit maybe as satellite positions. But if you're buying an ETF which is a broad-based ETF, so like an index tracker or an active ETF that Ted's been talking about, which stay very close to that index but still have that latitude, they have that flexibility to give you the chance of outperforming over time, then those types of ETFs you can use as the core of your portfolio. So yeah, just to summarize, I'd say make sure you've got that solid core as your foundation of your portfolio. Then if you want to expressively using thematic ETF or two, absolutely fine. Just make sure it sits as a more satellite position and doesn't increase the risk of your overall portfolio too much.
Andy, I really hope people were taking notes there of the 6 Ps. You're probably going to have a few DMs on LinkedIn to remind them of what number 3 was along the lines there. But that was a really nice breakdown and a really great way to kind of memorize and understand that kind of answer. It would make sense to obviously talk about risks and opportunities when we're talking about investing in general. And of course, when it comes to risks, 2024 was pretty much the year of the election, right? We're talking over 50 countries having elections. That's pretty much over 50% of the world's population, roughly 1.5 billion people expected to actually go to the polls. So quite a big year. So Ted, I'm going to put this one to you. How might some of these recent elections and potentially some of the more macroeconomic factors in 2025 impact ETF performance and investor strategies?
Yeah, so you're definitely right, Gabriel. It was a busy year from a sort of political perspective. The way we think about it is that politics is clearly important. It dictates policy. It can be a lot of noise as well. And if we think of the US election, obviously we're just coming out of that. Markets reacted incredibly strongly on the back of the narrative around that. But the new administration hasn't been inaugurated yet. We don't know what they can get through. And so, yes, the way we think about it is you've got to keep an eye on the policies and the politics coming out of central governments. However, from an active perspective and way we think about things is you've got to understand the companies, and actually looking at valuations and understanding the businesses that we are investing, whether it's equity or fixed income, will be very, very important. And that's why we think, sometimes an active approach where we have got research analysts who are meeting company management, on a regular basis to really understand, one, how these businesses are performing today, but how potentially policy and other future events will impact these businesses going forward. So yes, we need to keep an eye on it. We need to we don't want to front run these things. You don't want to understand, until the actual policy is in place, it's sometimes quite hard to value these ideas. And so, yes, we think potentially we have another strong market next year with 2025, but let's just keep an eye out in terms of what policies actually get put through. I think the other factors that we have to think about in actually what's happened is equity markets have rallied incredibly hard. 2024 has just been a phenomenal year for every asset class. Hopefully everyone on this call is sitting on some nice attractive gains, which is great. Unfortunately, as we know, markets don't go up in a straight line. And so there could well be volatility for next year. And so to some of Andy's points earlier, stay diversified, manage your portfolios to the risk level that you are comfortable with. You personally know your own risk tolerances and make sure you run your portfolios in the appropriate way. And the great thing about ETFs is that there is so much choice for you out there. They are wonderful building blocks to build really robust portfolios, whether it's an active or a passive ETF. And so go spend that time, use that analysis that Andy spoke about, and build diversified, sensible portfolios. And obviously have a bit of fun in terms of the tactical stuff, but make sure you've got a solid core in there, because things can change quickly. I think if we look at the fixed income market, yes, equities rallied hard, but now everyone's getting nervous that maybe inflation is going to come back in the US. And so you've seen the 10-year fixed income curve kind of steepen again, which obviously has led to more negative returns in the short space there. So just stay nimble, but stick to your knitting, as they say, and manage your risk profile based on your personal circumstances.
Really, really brilliant answer. You are both obviously leaders in the ETF space. And I'm going to pose this question to both of you, but starting with you, Andy. What is one investment lesson or insight that you've personally gained that you think that every retail investor should probably know heading into 2025?
So I think this kind of harks back to what I was saying at the beginning of the chat. And I'm basing my advice really on what I've seen DIY investors do on the InvestEngine platform, which is kind of do either the money market fund or the full equity tracker. Because what actually happens when you sit most clients down and you talk to them about their risk profile, you take them through a full risk profiling process. Most investors in reality sit somewhere between 30% equity and 70% equity in their kind of attitude to risk. So there is this mismatch between what investors think they should be investing in, either no market risk or full market risk, and what they should be investing in based on their risk profile if it was measured. So I think my advice would be that before you just go and stick everything in an all equity ETF, make sure you've considered your risk profile, put some thought into what your actual kind of equity bond split should be based on your circumstances. And as a hint, as a tip, if you're not sure, because I know it can be quite tricky to figure out what your risk profile is, you can take a free questionnaire on the InvestEngine website, which is part of the managed portfolio sign-up process. You don't actually need to create a managed portfolio. You can just do the questionnaire if you want. It's totally free. But that will, at the end of it, recommend you a portfolio, which should give you a pretty good starting point of what your portfolio should look like based on your own risk profile. Yes, that would be my advice. Just make sure your portfolio aligns with your own risk profile.
Brilliant. I guess, Ted, same question over to you. What is that one lesson or insight you want to share with those listening for 2025?
Yeah, I'd say don't try and be a hero and time the market. It's very difficult. Like long-term investing over time shows that you will, if you build a robust portfolio that we've spoken about, you will do well, you will have a nice retirement. I think if you try and time the market, the information, markets are so efficient now, it's very, very hard to do that. And so, as I said, have a very robust process, whether that's outsourcing to someone like InvestEngine or doing it yourself. That's a great starting point. The other piece I would say is partner with a good platform. So InvestEngine are a great example of that, where the fees are quite low and they've got great access and great products available, and obviously good content to support you on that journey. We all need support as we go on this investment journey together, whether it's reading educational materials or understanding research from different companies and ETF providers. So take all of that in. And as I said at the start, unfortunately, volatility won't disappear, and it's going to be bumpy rides along the way, and it's not always going to be going up. But if you stick to your long-term goals and your investment process along that, stay diversified, then you will have good outcomes in the long run. So slightly boring, I'm afraid, but sometimes boring is good.
I've been a long time sayer of the fact that investing should be boring. I love it when investing is boring. So you're speaking my language, and hopefully the language of a lot of people listening. We have come to the end of our more formal part of this session. So it is now time for a Q&A, as I did promise at the beginning. And Ted, I'm actually going to stay with you on this one because I want to bring us back to the conversation around active ETFs. The Q&As got very hot around that period. And one question that came in from Alejandro was, how does the cost of active ETFs compare with passive ones and mutual funds?
Fantastic question, and such an important one, because ETFs, the genesis of ETFs was that they were low cost building blocks. And then suddenly people are worried the active management industry is going to come along and kind of ruin that story. Luckily, and one of the reasons we're seeing such growth in active ETFs is they are very cost effective as well. And there's a couple of factors to think about. So obviously they're not going to be quite as cheap or cost effective as a passive, because there's a lot more involved in terms of managing the active portfolio. But obviously in return for that, you hopefully get excess return. So they are going to be more expensive. But the wonderful thing about ETFs is that they're very efficient vehicles for J.P. Morgan and other asset managers to run. And so our operating costs to manage an ETF versus other structures, like you mentioned mutual funds, are a lot lower. And so we can pass on those kind of operational cost savings back to you as investors in lower fees. So I would say they kind of sit in the middle between passive and traditional active strategies. So definitely very cost effective. You can go on the InvestEngine website, our own website at JP Morgan, and see our fees. But we have a whole range of different kind of strategies. And obviously the fee will be dependent on how active a strategy is. But we've got active ETFs there that are pretty much priced in line with passive, but hopefully also delivering excess return. So yeah, don't worry, you're not going to be getting a load of expensive active ETFs hitting your radar. This is hopefully bringing the best of both worlds together. The great benefits of the ETF, which includes cost, with some high quality active management embedded within that vehicle.
I'm telling you, active ETFs is the hot topic right now. Even you bringing that up again, more questions coming in, which is absolutely brilliant. But I do want to give a chance to speak about ETFs as a whole. So Andy, quite a common question coming in from a few people is regarding specific sectors within the ETF industry. One question is any particular sectors that you're looking to recommend in 2025? And a kind of follow-up question, or maybe one that you prefer to speak to, is should one go for broad-based ETFs or more sector-specific ones? Any advice on kind of where to start within that, considering a long-term investment horizon?
Yeah. So again, I think I'm going to hark back to what I was saying before about keeping diversified. I'm not going to go out and recommend you invest in any particular sector next year. That's a recipe for disaster, really. That's really trying to time the market, and that's timing the market is just something that you really shouldn't do. It's been proved over and over again to be impossible to do repeatedly over the long term. So what I would say in terms of that question around the broad-based ETFs or more sector-specific ones is that as long as you have a broadly diversified portfolio that spans multiple sectors, then you're going to be on the right track when you put together your equity portion of portfolios. You can build that in a number of different ways. You can, for example, allocate multiple ETFs depending on the region. So you can have a US tracker, you can have a Europe tracker, emerging markets, UK, and you can build your portfolio that way. You can keep it super simple and just invest in a single global equity tracker, as long as you know that equity, 100% equity is what you should be investing in. And you can always temper that with a bond allocation as well if you want to. Or again, you can go by sectors. You can kind of build a portfolio of sector-specific ETFs to build up a diversified portfolio that way. As long as you have a kind of robust core that we've been talking about, like the active ETFs that Ted's been talking about, that can kind of fill that core portion of your portfolio, then, as I said, you're going to be on the right track. Now, you can take active bets by having sector-specific funds in there as kind of satellite positions. absolutely fine. If you think that there's a specific sector that's going to outperform next year, then by all means allocate a small portion of your portfolio to that. But just make sure that the majority of your portfolio, the kind of 80-90%, is in a broadly diversified portfolio of index trackers or active ETFs that aligns with your own risk profile by including bonds in there as well if needed.
Really interesting. Ted, back over to yourself. And this is a very short but to the point question. How does one decide when is the right time to cash out of an investment? And I'm particularly interested again around maybe potentially the way that active managers look at how they're building these ETFs.
Yeah, it's a great question. And that's actually one of the biggest challenges in investments. You can always look for sort of a cheap, exciting opportunity, but when do you obviously exit that and hopefully lock in some attractive gains? And I think it really depends on the strategy. But I think, when you go into an investment, you often have a target price in mind. And again, you have to have a very structured research process around that. So you go in thinking, actually, the fair value of this is X. I'm getting it, in my opinion, at a discount. And when it hits that X price, time to be disciplined. And often it's difficult because things change. And then I go to exit it. Now, obviously, you're getting regular updates from the companies. And this is why, partnering with sort of bigger names like ourselves and other bigger asset managers, who get to go in, as I said, and meet the CEO, the CFO on a quarterly basis to understand, how is their business dynamics changed from last quarter? What are they looking to do next quarter? How will that impact the share price? As I said, keep an eye on the macro piece as well, any policies that might positively or negatively impact them. So it's a very hands-on approach. And that's why we tend to say ETFs are such fantastic vehicles, whether passive or active, because you're almost outsourcing that responsibility to individuals like ourselves and InvestEngine, who have armies of analysts who are here, full-time employees to make those decisions. It's quite hard to do that on your own at home. Yes, there are some great people who can do it, but it is time consuming. And so I would say that that's where the ETF vehicle has been such a wonderful kind of invention for investors, particularly retail investors, because you can outsource it and not have to pay too much to do that as well.
Thank you very much for that. I do want to say, by the way, for all of you listening, we can see your questions still coming, and I apologize if I'm not getting to all of them, but Lisa, Shay, Zach, Alejandro, Adam, Sarah, we can see all of these questions. So do keep asking them and I'll try and get to as many as I can. Andy, one question that has come in that I assume is something that you are very familiar with, which is how can retail investors discern the quality of ETF issuers or fund managers? And seeing as InvestEngine are quite literally doing this themselves, how do you go about this? And then how would you recommend retail investors take a look at this?
Yeah, that's a really good question. And I think if you're a retail investor that isn't maybe familiar with a lot of the names in the investing industry, it's quite hard to know whether somebody is a brand name or not. And it's quite hard to discern whether they're a kind of trustworthy big name or maybe a newer entrant into the ETF industry. So what I would say is a good starting point. Go onto their website, have a look through the website, have a look through the literature they've got around the ETF. A good indicator of how popular an ETF is to look at the AUM of the ETF. The AUM stands for assets under management, and that will tell you how big the ETF, i.e. how much cash is actually invested in that ETF and the ETFs in that kind of family. So that would be a good starting point. If it's got a lot of AUM in it, then you can be confident that it's a big ETF, it's a popular ETF. The ETF issuer, the fund manager, is likely to be stable, and it's likely that you're going to be in good company on the kind of shareholder register. So I'd say that looking at AUM is probably a good starting point, but also the kind of way that the ETF issuer communicates on the website. I'm using the website because that's an easy thing for retail investors to be able to go and have a look at. Is a good indication of the kind of philosophy of that ETF issuer. One of the benefits of ETFs is they're really transparent, and you want to see that transparency reflected in the commentaries, in the website. They want to be transparent on fees, make sure that you can get a really good drill down into what you're paying, because some issuers, especially in the mutual fund land as opposed to ETF land, can tend to be a bit more opaque around what they're charging. So make sure that the ETF issuer that you're looking at is very clear around the costs, not just the OCF, but also the underlying transaction costs of the ETF as well. That's important. And also how much you're paying in spread, because that's something that is a little bit more difficult to figure out, but also has a big impact over time. And spread, sorry, just a bit of jargon there, is how much is charged by the kind of intermediary between the buyer and the seller to facilitate that trade. So there's a few different things to think about, and I've got to keep this brief, but in short terms, go on their website, have a look at the funds, see how big they are, see how transparent they are, and that should give you a pretty good indication of whether that ETF issuer is high quality or not.
Really, really well summarized. And thank you for keeping that brief. I mean, I think both of your answers have been absolutely brilliant. You've handled the rogue ones from the audience, from the public really nicely. So I do want to say a big thank you to both Andy and Ted for sharing such brilliant insights in the world of ETFs, and of course to all of you guys tuning in for asking your questions. I really do hope that you've all taken something away from this session. That is the reason why this is put on, not just for you to listen, but for you to learn and obviously take that information into 2025. And just to let you know, don't go anywhere, as coming up straight after this is session number 11, which is titled How to Build a Winning Portfolio with $10,000 with Stashaway. It does start in about 15 minutes, so stay tuned, folks.